You are listening to a special preview of the KE Report Weekend Show with your hosts, Corey Fleck and Al Corlin. This preview is brought to you by our friends at goldeagle.com. To listen to the full 2-hour weekend show, please visit www.kereport.com on Saturday morning. Welcome back, here to kick off the second hour and continuing our conversation with Jeff Christian from the CPM Group. Jeff, as a wrap-up to the last segment, you did mention that for some of your clients and subscribers, you are saying that now is a good time, you think, to get into the market almost in an accumulation sense. Can you explain why? Is this because you think that we are in the beginning parts of another bull run, potentially?
Yes. I mean, most CPM Group investor clients are long-term investors. And if you look at our recommendations going back over the last 7 years, in 2010, we were saying we thought that the gold price could peak in or around 2011, and that we could enter a 3 to 5 year downward phase. And the way we characterized it was that we thought that there was a secular bull market in gold that started in 2000 and was continuing, but that there could be a cyclical interruption and correction downward for 3 to 5 years, followed by another leg up. And our analysis suggests to us that we've seen that downward leg, and we're now in the early stages of another much larger upward move. So for a longer-term investor, our view is that the gold price over the next 10 years probably rises to record levels that surpass the 2011 peak on a nominal dollar basis, in terms of the value. So we're looking for the gold price to rise sharply over the next really 3 to 10 years. We're telling our clients that we don't know that they'll rise sharply right now this year, 2016, or even into 2017, but that as time goes on, the economic, political, and financial market problems that the world faces and that individual nations face and that individual investors face, that set of problems will just grow worse. And at some point, maybe in 2017, maybe in 2018, we're going to see a resurgence of global investment demand for gold, which will probably drive the gold price to a record high. So what we're telling our clients is that we think the low is in, and if you have a stomach for a couple of years of perhaps a little bit boring markets, this is the time to buy gold as a wealth preservation instrument and a portfolio diversifier.
Jeff, what are the thoughts that brought you to the conclusion that 3 to 10 years from now we're going to see a sharp appreciation in the price of gold? I know, a lot of the pundits who sometimes I don't have time for some of their wild, outlandish predictions, like $5,000 gold, $10,000 gold, what have you. Are you looking for an increase of that magnitude?
No, we're looking for gold prices to be nominally around $2,000 5 to 10 years from now. So we're now looking for 5 or 10,000. The fundamentals of gold don't really support the high of prices on a sustained basis. If you ever saw gold spike to $5,000 or $10,000, you'd see a massive amount of gold supply coming in, not only from mining companies, but from all of the jewelry that's been bought over the years. There's a couple billion ounces of gold in jewelry. And if you look at the period 2000 to 2011, gold scrap refining from jewelry basically doubled as the price rose from $280 to $1,600 on an average basis, annual average basis in 2011. So there's a lot of gold that can come into the market if the price rises. In addition to which, if the price got to $5,000, you would be killing the jewelry industry, which is, again, accounts for 70-80% of gold offtake every year. A lot of investors would say, well, gold was attractive to me at $1,300 or $1,500, but at $5,000, I think I'm going to sell what I got, or at least stop buying. And you've got 1 billion ounces of gold in central bank holdings. You've got 1.3 billion ounces in investor holdings. You got more than 2 billion ounces in jewelry. So if you saw the price go that high, and you could see it spike that high, but it can't stay there because the fundamentals of the gold market simply wouldn't support it.
Jeff, that's such an interesting comment on the aspect that the scrap metal business would pick up, because I think we all remember back when gold was on that run, just all those commercials you would see about all these people willing to cash for gold. We'll take your gold, we'll give you cash. And man, did those things ever just dominate the airwaves.
Yeah, and a lot of them are gone now, right?
Absolutely. Jeff, one other comment and kind of a different viewpoint here. What do you think about this new Shanghai gold fix that has just come in a few weeks ago, I believe?
It's not surprising. They've been talking about doing this for several years. It's the shape of things to come. I mean, the reality is that London is still the financial capital of the world, but it's the financial capital of the world because it's based on history. And if you look at the growth of economics, there's been this continual shift for the last 30 years in economic activity and economic power eastward. And China is the dominant entity there. And China is, it's the largest mining country for gold. It's the largest refiner of gold scrap. It's the largest jewelry manufacturer. It's the largest investment market. And it's going to continue to to grow in size relative to the rest of the world. So it's only a natural occurrence that you'll see a shift in where the price is made from London and New York to Shanghai. You're seeing the same thing in oil, where the Shanghai, the Chinese regulators are opening an oil contract in Shanghai with the expectation or the hope that increasingly oil will be bought and sold based on the Shanghai price as opposed to the Argus price or the West Texas or the Brent prices.
That's an interesting comment. Now, in light of the slowdown that's going on currently in the Chinese economy, I'm not really sure how a 5 to 6% growth rate, annual growth rate, really translates to necessarily a meaningful slowdown. But, if that, in fact, is the trend, and if those numbers continue to decrease, perhaps the importance of China could diminish. What do you think about that?
Well, it could, but take this into context. The 6.7% growth we saw in China last year in dollar terms was as great as the 14% growth that we saw in China in 2007. So part of what you're seeing with the slowdown in the percentage increase in Chinese activity is simple arithmetic. As the economy gets larger, the same actual growth in economic activity is a smaller percentage of the previous year's GDP. So part of it is that, our expectation is that China, again, if you go back to 2007, Chinese GDP was probably about $3.5 trillion, just to give you an idea, and it went to $4.5 trillion the next year. Last year, 2014, it was about $10.4 trillion, and it's now about $11.4 trillion. So you're seeing the same growth, it's just a lower percentage. And China is doing something that's never been done before. It's trying to convert 1.4 billion peasants into consumer people. And they've transformed about 400 million of those people into urbanites who consume stuff and who participate in a modern economy as opposed to being subsistence farmers. They still have 1 billion people out in the fields, many of whom want to move to the cities, and they're continuing with this rapid urbanization. So I think that there's a tremendous amount of economic growth still available within China. Now, as they do that, they run into economic problems. I mean, everybody runs into cyclical economic issues. We're growing too fast, we get inflation, then we try to fight the inflation, and we grow too slow or we slip into a recession. And China is running into those same issues. But I think the broader economic trend in China is going to be growth, unless there's another revolution that upsets the entire apple cart.
You have actually just, in my opinion, given an excellent summary of why you can't disregard a country the size of China and the aggressiveness that the Chinese people have. You simply cannot dismiss a country like that into the future by saying, well, the GDP is going down, et cetera, et cetera. There are so many positive factors in line that you brought out, Jeff, so many positive factors in line for continued substantive growth in mainland China. Ladies and gentlemen, stick around. We're going to be right back.